sort of a prequel, if you will, to what I'm scheduled to speak tomorrow at the PDAC morning session of newsletter writers. So that's what we're going to do. I'm going to go over. I don't really do big picture things like where's gold going and that. I've got my opinion. I think you've all got your opinion. But when it comes down to the mining side of things and what's happening in the mining industry right now, I think it's really important and a unique time in history that we're fortunate to be in. And I think because of what's going on, we've got the opportunity to make a lot of money if we're very careful and do a lot of due diligence. Then I want to go into the odds of success, my usual discovery price curve, which I think is really important, a due diligence list, and a few ideas. And I usually try and leave time for questions and answers. I don't know if we'll have that today, but I'll be out there afterwards. All right, how much are we mining? We're burning through 1 Bingham copper deposit every year. That's 19 million tons of copper production globally. For those of you who don't know Bingham Copper Mine, it's one of the largest, richest copper deposits in North America. It's just outside of Salt Lake City. As you fly into it, you see it there. It was discovered and began as an open pit in the early 1900s. So we're burning through one of those every year. Now, if we were to find one of those today, the timeline from discovery to production, we're looking at something in the order of 7+ years to 20 to 30, depending on the permitting issues and such. And obviously, if this was found today outside of Salt Lake City, it wouldn't even be built. And to build it's going to cost us billions, $5 billion to build this whole thing. So these are really big things we've got to replace in short order. These are the top 16 copper producing mines in the world. They account for 41% of production. These are over 20 years old, and we need to duplicate these over the next 16 over the next decade. How do we do it? What's the capex to do it? And another point I want to bring up here is our break-even costs in copper, all-in break-even costs have risen from 65 cents back in 2000 to about $2.50 now. So that's an added hurdle we've got to get past, or the major mining companies have got to get past. What that does, that's pretty much our base price. Regardless of what happens globally and in China and that, I think that is a base price that we've got to look at. This is a study from the, Canaccord Ingenuity. Current mine production, there was 19 million tons. Copper demand in 2016 is estimated to be about 26 million tons. What you'll see here is where it's coming from. The lower three right there, that's scrap, what we're going to get from scrap, expanding mines, and deposits that are in production. What we've got up here is where we're projecting the rest of this 3.5 million tons is going to come from. The first bar is new mines expected, and the second bar, that's yet to be discovered. And then you can see where the demand looks like. So this is a serious issue. And this is the top 10 copper producers on how much they're producing annually. And again, the top 4, Escondida, Chuquicamata, Collahuasi, and Grasberg, biggest copper deposits in the world, their production has got to be replaced. Or I say that what they're producing annually has got to be replaced. And again, these things were discovered from 1860 to 1996. There's nothing up there that says more recent, and even the 1996 is an odd one. Ditto with Carlin, with the gold on the gold side of things. We're burning through 1 Carlin trend every year. That's 83 million ounces is what we're producing globally, and that's what's been produced from Carlin. And Carlin, again, it was discovered basically back in the 1980s, and it's got a dozen or so major deposits along there that have taken 35 years to bring to this stage right now. And that's what we've got to replace on the gold sides of things. And again, capex to build this thing is going to be $30 billion. If it's well located. If it's up in the Yukon, it's even more. What this slide shows here is the trend in global production. What we're seeing here is the bottom blue, that's Western world production. You can see it rose up until about 1990 something. And that rise was possible because of a new technology, heap leach technology, where we could just sprinkle acid on top, or cyanide on top of a heap leach and recover gold. That made a lot of previously uneconomic deposits economic. So that accounted for that production. But you see that production dropping off? All those near surface oxidized leachable deposits, were running through them. But about the same time that started dropping off is when basically the rest of the world opened up to exploration. So we were able, as explorationists, to go out there and find these, easy sitting at surface deposits and bring them into production. So that kind of filled the gap. And you can see that started dropping off at about year 2000. In the past 2 to 3 years, we've had an increase in production. And that increase is not due to new discoveries per se. What it's due to is the increased gold price, which has made previously uneconomic grades economic. So we're mining lower grades as opposed to finding new deposits and filling that gap. Big issue. Where are we going to replace that? Ditto for the iron ore production as well. This is a chart from Rio Tinto that shows the amount that they projected would be in production in 2008 to 2010 versus what actually has been put into production. And you can see the same thing below, what they're projecting going forward from 2011 to 13 versus where we are. We're not keeping up. We can't build these mines, find and build these mines quick enough. And which leads to this final little statement here. Metal supply as a function of time can no longer keep up with metal demand as a function of time. That's a really interesting concept. Until now, we've been able to, as the copper price went up, more copper production would come in and we'd bring the copper price down. That can't happen now because physically we're unable to just go through the whole process of finding, developing, building a mine, getting through the processing, the permitting issues, all the political issues, all the financing issues. I'm trying to borrow $1 billion right now. It's not that easy. So all these things are delaying us, and we don't have the skilled people to do that as well. There's just flat out not enough mining engineers, geologists, chemists, metallurgists out there to do the job. So we're in big problems. So what this shows here is each one of those circles is a development project that's on the books, that's gone through the feasibility stage, and the circle represents more or less the CapEx, size of the CapEx. These are all over 400 million. There's 400 sitting there that in theory could go into production, but in reality we can pump 20 to 30 through every year. We just can't keep up. On the positive side, the major gold miners, given their current gold prices, even with their escalating baseline costs and all-in costs, are accumulating a lot of money. You can see here that overall there's 2.8 billion sitting in as free cash flow to the major miners, and you can see some of the major ones there and how much they've got sitting, free cash flow they're generating. But the issue is, look at their cash costs have gone from 340 an ounce to 620 an ounce over 5 years. And that's just your basic cash cost, and it's probably closer to 720. All-in costs are in the order of $1,200 an ounce. So the miners are generating this cash flow, they're accumulating, but what they need is not big, low-margin, bulk, low-grade deposits. They need high-margin deposits. That's what they're looking for. That's what they're going to be buying. So how do you find them? Let's just go find them. The answer is easy. Go find them. They're looking. This is a slide from Barrick. I think what it shows is the number of discoveries per year and the ounces that represents. So you can see starting at the left, there's our 100 million ounce mark. In the first year, in 92, there were 6 deposits found. And working across, you can see that it rose, but lately it's been dropping off. So what we're finding here is not enough deposits. So what I put up on here, there's our expenditure in green, which is about $5 billion just on gold exploration alone. This doesn't include copper and the rest. This is just gold exploration. The blue, that little star, that's current production. And down here at the bottom, that's what we're finding. Last year, or in 2009, it looks like we found in the order of 35 million ounces versus production of 80-something million ounces. That gap right there, that's our opportunity. That's where I want to focus. That's where we all should be focusing on, is identifying the deposits, or the prospects, I should say, that are early enough stage that they're still reasonably priced that the major mining companies are going to buy. I mean, Ethos was just up here talking. That's one you should be looking at. Keep an eye on that one. it may be one that fills that gap. All right, so this is some data that was put together by Steve Enders, ex-Newmont VP Exploration, and in conjunction with Barrick as well. And these are the odds of discovery. And these are really, really bad. And I want to point out that this has just looked at everything, every prospect out there, every company, junior company that's being explored. There's about, on average, 10,000 exploration properties being explored annually. Out of those, the probability of finding an economic gold deposit, one of greater than 1 million ounces, is about 1 in 1,000. And the probability of finding one that's 4 million ounces or better is 1 in 10,000. Now, this is economic deposits, not resources, not inferred. This is economic deposits. Big difference there. And the little pie chart there shows exactly what size they are. You can see that 2% of deposits that are found and put in production are greater than 500,000 ounces. So most of the deposits that are going to be found, that are in existence, and that will be found are going to be less than 500,000 ounces economic. Oh, I got that little star there. That's to remind me that tomorrow, I think at 10:50 at the PDAC in room 101, I'm going to be talking about why this is so hard. You know, get into some geology, and the real reason I think that it is so hard to find out or to discover new deposits. I think that's a really important concept that a lot of investors don't really get. I mean, everybody's, you'll see all the companies at the show. They've all got a great story. They're all just on the verge of making a discovery, but let's look at why it's really tough. Okay, this is the second graph. Again, I use this graph a lot. Any of my subscribers have seen it a number of times, but it's a really important concept to keep in the back of your mind when you're investing in a company, is where on this chart are you? Most companies start off, and here we've got the lower early initiation where some guys get together, raise some money, go out, stake some ground, and start doing soil samples or rock chip samplings. As it progresses, we start getting more positive results. We start seeing positive geochemistry or geophysics or rock samples. A drill hole starts shooting us up that curve. And eventually we get to the top of that curve, and then one of two things happens. Either it's good enough that a major buys it, or they're left with the work of proving it's economic, which means a lot of detailed engineering studies, metallurgy recover, permitting issues, social issues, and that's where things tend to drop off in there. And then the second part of the stage of the curve is where you're actually successful in proving it. Now, given the odds I talked about before, if we know most of the companies that appear to make a discovery start up this curve, if 95% of them are going to go back down and end up at the bottom of that curve and never come back up again, it's really, really important to interpret the drill news. You need to really understand what a company's got, what they're looking for, what their results mean. Key, because 95% of the times you can make money on a non-discovery, but you need to know what's wrong. And in my letter, I talk a lot about, I'm always looking for the fatal flaw. If we know there's probably going to be a fatal flaw, that's what I spend a lot of my time looking, which is sort of a negative aspect to it, but I think that's what you need to do, given the statistics, what we know. So obviously that's all you need to do. Okay, I'm going to make it easy. Geology 101, there are 2 rocks you need to know, 2 rock types. You going to write this down? You're smiling, you already know this. All right, that's what a good rock looks like. This is a share chart of a company called AUEX Ventures. They made a discovery in Nevada, Carlin-type deposit. Frontier was their partner. It continued to get better. And this is simple, but the characteristics of a real deposit are it tends to get better with each round of drill results. It doesn't tend to get worse. And you can see how it went up. And we've got over 1,000% gain on this thing. It was bought out by Frontier, and then Newmont bought them. That's good rocks. This is not the usual chart. Some of you may know that. This is more the typical chart. Bad rocks. You can see the hype, some flashy results, some visible gold in rock samples, some selective sampling of those samples, some very specific drill holes, and comparisons to, this one was being compared to Red Lake. So on their presentation, you'd see their little, where they've drilled a few holes and the whole Red Lake deposit down below that at such and such a grade. Well, this is how most of these end up. So again, if you knew that, you could still make money on this, or at least get out of it in time. You've just got to be smarter than the crowd. Okay, so I've got a whole list here of risks versus reward, different exploration models, different company models, that sort of thing. I'm not going to go through that in detail, but you're all welcome. If you just email me through my website, I'm happy to send this list to you, because that's the solution to this problem. Is if you've got this list of things to look for and to judge against what your company's doing, you're ahead of the crowd again. That's the solution to this issue. And I'll give you a couple of companies that I think are worth writing down and investigating. One is Lydian International, gold deposit in Armenia. I've been there. It's a good country. I think they're going to get it permitted. They've got 3.2 million ounces grading 0.95 grams per ton. That's a low-grade deposit, but it's oxidized, meaning the Mother Nature has turned the iron to rust. When it turned the iron to rust, the gold was liberated, so it's very, very easy to recover the gold, very inexpensive. I've run through, I always build models on these things. So I've run through and built a model on this. At $1,500 gold, you can see sort of where it ends up. After-tax NPV at 5% is greater than $1 billion. Their market cap's 270. Now, I'm not saying we're going to get this. This is something I think a major or mid-tier company should be buying. But I think the risk to reward here, 270 versus $1 billion, it's not bad. And the other one I'll talk about briefly is Eurasian Minerals. They follow the prospect generator model, which is recognition of the odds, of the long odds of success. So what they do is generate intelligent, big picture ideas and bring in somebody else to spend the money, the high risk, expensive money, thereby preserving their share capital and, as investors, our piece of the business. Not piece of the property, piece of the business. So the business is one of generating ideas. We want to have a bigger piece of that business rather than the high-risk part of the actually exploring it. You can see the numbers there. They just bought a royalty, which means they'll never have to finance again. And they've got a number of good projects out there that I like. The newest one is Coonamberry in Australia. They've staked a whole belt, 100-kilometer-long belt of rocks where local prospectors are just digging up gold nuggets like you can see here. It's never been drilled. It's sort of a new area. This is what the geophysics over it looks like. So we're starting to get a feel for the geology. Each one of those yellow triangles is where they picked up one of those gold nuggets. So this is a really interesting thing. Now, they're not going to drill this themselves. They're going to bring someone else in to test it. And they've done this with projects in Turkey, the Western U.S., Sweden. Where else are they? Anyway, they're scattered across the world with this sort of thing. So this is the sort of thing that I think is intelligent exploration and low risk, high reward. That's pretty much what I wanted to say. Send me an email. Thank you so much.